Welcome to this weekly update. I'm Julia Lee, an equity strategist with Bell Direct. And this week, the highlight was most definitely the energy sector, where we did see oil prices spiking above $50 a barrel on the back of those OPEC production cuts. However, the death of high PE ratio stocks from a reduced earnings guidance continued, and this week in the firing line was Vocus Communications as well as Bellamy's, both stocks which were absolutely hammered. But let's focus firstly on the energy sector, and with energy spiking so much, you might be wondering if there are still opportunities in this space. Well, Deutsche Bank focusing on the energy space this week and having a look at the implied oil price in current stock prices. On the basis of that, the cheapest stocks look like Oil Search and Santos, both stocks where Deutsche Bank has a buy on these stocks. And of course, the most expensive stocks are Woodside Petroleum as well as Cenex Energy, where Deutsche Bank has a hold on these stocks. Going from one of the best performing areas to one of the worst performing areas, and that's the property sector or the real estate investment trust, the REITs on the Aussie market. In fact, since the peak that we saw in July for this sector, we have seen this sector losing 17%. Sure, though, seeing some opportunities in this space, saying that the forecast total shareholder return is 13.9% over the next year, with the distribution or the dividend forming 5.1% of that return. The stocks it likes in this space with a buy include Lendlease, Gateway, as well as Mirvac. It has a hold on Goodman Group, as well as Stockland and Vicinity Centres, but a sell on BWP Trust, which of course has a lot of the Bunnings properties in that trust, as well as Dexus in the office space. Moving on to metals and mining, and once again the upgrades in this space continue from brokers, this time from UBS, which has moved to an overweight rating in this space for 2017. Its most preferred commodities though are copper, nickel as well as zinc. Its least preferred commodities are coal and manganese. Look, UBS are focusing on global resource companies, so not a lot of Australian exposure ideas here, but in its least preferred space because of its manganese view, it least prefers South 32. Looking at Morgan Stanley for a bit more of a sobering view on asset allocation, and a number of brokerage houses have been saying the same thing throughout 2016. Looking at lower returns or a lower return and a lower growth world, Morgan Stanley is saying that the cash peak here in Australia is now expected at 3.5% for the cash rate. That compares to previous peaks over the last 20 years, which has averaged 4.6%. Saying that if you were looking at an Aussie portfolio of 60% Aussie shares and 40% Aussie fixed interest, you'd be expecting a return of 5.8% per annum compared to a historical long-term average of 9.5%. So there it is. It looks like returns may be harder to come by in this low growth, low return world. Morgan's though focusing in on what's been happening and looking at Morgan saying, look, the Trump bump continues on. We have seen an unwind though of high PE ratio stocks as well as bond proxies, instead money flowing into banks as well as resources, and that has continued even though it does seem to be slowing. Looking at Morgan's and some of their high conviction ideas where they have added ResMed as well as Speedcast to the list, saying that the upturn in the US investment cycle as well as a tailwind of foreign exchange sees these companies added to their high conviction list. And finally, ending with a whole raft of stock ideas from Credit Suisse. And if you are looking for stock ideas, Credit Suisse has an outperform on REA Group, Caltex, Suncorp Metway, as well as National Australia Bank, but a neutral on Westpac. I'm Julia Lee from Bell Direct. Hope to see you next week.